India's trade deficit narrowed to a 17-month low in February on a sharp fall in import of oil and gold and electronics, the items that form the bulk of the country's import bill. Despite crude oil prices actually rising on a month-on-month basis, other macro indicators including factory output and the GDP also point towards a slowdown in the overall economic activity. To discuss about the shape of the economy, we are now joined by Sajjid Chinoy, Chief India Economist at JPMorgan. Sajjid, a very good morning to you. A whole host of data points that came out over the last few days.
Good morning.
We had the WPI, CPI numbers. We had the GDP numbers coming out a few weeks ago. I mean, how do you put all of this into perspective with the latest numbers that have all come out, be it with regards to the 17-month low, trade deficit numbers, the increment in the inflation print, the CPI print, with food prices coming up on a month-on-month basis? Put it all into perspective for us.
Yeah, well, I think there are a lot of cross currents here, so it's important to stem back and disentangle all the different pieces. Let's start with growth. I think it's easy to say that growth is slowing in India. One can look at the GDP numbers and say there's a sharp slowdown in the last quarter, and perhaps growth will slow even more in the next quarter. Or you can look at the import number. But if you look more closely, the data is much more mixed. There are a number of indicators which have also firmed up. We're seeing the surveys, the PMI surveys, both manufacturing and services pick up quite smartly. We're seeing both cement and steel production pick up. We're seeing credit growth not only make up for some of the NBFC void, but also broaden. And for the first time, there's some credit offtake to industry and infrastructure. Now, offsetting that, of course, is the fact that imports this month were quite weak, though the trade data is very choppy, so I would reserve judgment till we've seen a few more months' data. And IP numbers have been bouncing around, but if you look at core IP, for example, that has held up quite well. I think the summary assessment has to be that while growth has slowed compared to 2 quarters ago, it appears to have stabilized. I don't think we're in the midst of a sharp growth slowdown. And the GDP numbers will be soft because you're contending with very unfavorable base effects. Remember, this is the time last year where GDP growth accelerated to over 8%. Against that base, we should not overinterpret these 6-handle prints. So my assessment is growth appears to have stabilized. The exports number, for example, in the trade print were actually quite encouraging. And there are a number of reasons for that. I mean, oil is down almost $20 a barrel since its October highs. That's helping activity by providing a positive terms of trade impulse. We're seeing that banks have stepped in quite aggressively to pick up the NBFC slack, and we're seeing that monetary conditions in the economy have eased. So there are a number of growth supports. Finally, let me say the fact that core inflation has been so sticky. We saw core in fact firm this month almost towards 6% and remain in this range between 5.5 and 6 for the last 2 quarters, tells me that activity is not that soft because producers would not have this kind of pricing power if in fact we were slowing. So the good news is that I think activity appears to have stabilized. There are some encouraging signs in activity. We just need to be patient.
Is the pickup in investment, fixed investment, which has remained strong in this print, a growth of about 10.5% in Q4 of FY18 versus 9.9%, a silver lining according to you? Or the fact that consumption growth has slumped a bit compared to the previous quarter dissuades you a little bit more?
Well, consumption has been the bulwark of growth in the last few years. And there has been some slowing in recent months, which is expected. A lot of auto production, for example, was financed by NBFC. So we will see consumer durables have to recalibrate, given what's happened in the NBFC sector. And there's been some modest slowing of consumption. I think what's a little bit more encouraging is that you're seeing some green shoots of fixed investment. I don't want to overstate the case. So far, it's been run largely by public investment and investment by states. And that kept gross fixed capital formation reasonably strong in the last few quarters. But there could be early signs here that there's some patches of fixed investment in the economy. You're seeing this in the manner in which credit growth to industry is picking up. Now, I don't want to overstate the case. We'll have to be patient till the deleveraging process plays out. Also, capacity utilization levels have begun to rise, but we need a little bit more of that to be more convinced that investment is picking up. So I would say that consumption is slowed a little bit, investment is picking up a little bit, and that's not a bad mix. I think a year from now, if you see some moderation in consumption and some pickup in investment, I think that will be the right mix for more sustainable growth.
The RBI governor in the last policy had laid a lot of focus on the economic growth. Now that inflation, the headline numbers were very comfortable for the RBI. Looking at these new numbers that we've received, and obviously the bringing down of the forecast of growth from 7.2 to 7%, does that make you think that there are more cuts lined up? I mean, the consensus is the next policy meet throws up 25 basis points, and that's about it. But are you in line with that, or you believe there could be even more?
I think the MPC reiterated that its legislated mandate is 4%, and that if its one-year ahead projections remain below 4%, that opens up some space for easing. That's what drove the February cut. The fact is we're seeing this big divergence between food and core inflation, and despite the fact that food prices picked up a little bit in last month's print, they remain very depressed compared to historical levels. So, our forecasts 1 year out are still, meaningfully below 4%, and that perhaps opens up space for a little more easing. We do expect another rate cut at the April review, just given the benign nature of headline inflation. But we need to be very mindful of what core inflation is telling us. That has been very sticky. The fact that core is at 6% tells me that there is not as much slack in the economy as we think. Output gaps are closing, pricing power is picking up. And our own research finds that over time, over a 12-18-month period, headline gradually converges to core. So I think that should worry the MPC a little bit. We do expect another cut in April, just given that the benign nature of headline and the trajectory in the foreseeable future. But I think beyond that, the MPC would need to be very careful just to monitor the signals emanating from core and to recognize that some of these year-on-year prints for growth are base effects, and we would expect that as the year goes on and these base effects normalize, the fact that growth is stabilized and maybe inching up should also be a factor. Remember, the global environment has changed dramatically. For starters, the Fed's undertaken a huge pivot. We now think they're going to gradually move in this new policy framework in the course of this year to average inflation over the course of a business cycle, and therefore expectations that monetary conditions are going to tighten around the world and global growth is going to slow further, must now recede. Also, the high frequency data is a little bit more encouraging this quarter. China's activity is surprised to the upside. We've marked up our Chinese growth forecast for this quarter, and you're seeing a little bit of traction on capital goods around the world. So I think the global gloom and doom that people had worried about 3-4 months ago will need to be revised, and I think that also helps India's growth prospects down the line.
All right. The other point being is, while we looked, you spoke about core inflation and the fact that that points towards pricing power, coming back in. The dichotomy between this and food price inflation, obviously on the rural side of it, starts to raise question marks because we're still in disinflation with regards to food prices. So does that pose a little bit of a conundrum with regards to whether you're actually seeing a pickup in rural demand and growth coming in from that aspect as well?
Yeah. No, as I said, there are a lot of moving parts here, so it's not easy to line up the data cleanly. I think all that one can say is there clearly has been some agrarian distress. I think in part because there's a supply side response to food as well, which we shouldn't underestimate, and that's kept food prices low in conjunction with rural demand also being relatively soft and global food prices being very benign. All of that, I think, has contributed to the food disinflation. But even though activity in the rural economy may be a little bit depressed, what we've seen is the urban economy has done quite well. Wages in the urban economy have been stronger. Urban consumption, in fact, has benefited from the reverse phenomenon. Just as low food prices create a negative terms of trade shock for a farmer, it creates a positive terms of trade shock for an urban consumer. So yes, we may be contending with two different economies here, a more slowing rural economy, or rather a softer rural economy, and a firmer urban economy. But the fact is the core inflation numbers are what they are. And this is not a 1 or 2 month phenomenon. This is now a 6 or 8 month phenomenon, and ties up with some of the RBI firm surveys, which also tell us that pricing power is picking up a little bit. So we just need to be mindful that if core inflation is going to be running between 5.5% and 6%, that is telling us something about the state of the business cycle. Interesting.
Sajjid, Neeraj here, good morning. Just one thought on what explains this renewed optimism on the FPI side for India. It's having its impact on what we are all slaves of the equity markets, but the currency as well, above 69 today. What is it that you believe is happening, and what is it you believe could happen over the course of the next few days/weeks?
Remember, there are both push and pull factors here. We discussed earlier very powerful push factors from the rest of the world. The Fed pivot caught a lot of people off guard. And the fact, as we were discussing earlier, is we believe when the Fed re-examines its monetary policy framework, we may well be moving to a scenario where the Fed is focused not so much on a 2% inflation target, but on average inflation of 2% across the business cycle, and therefore may be more willing to tolerate inflation shooting above 2% in the strong part of a cycle. That's a very different paradigm, and what that means is almost everybody now believes there will be no more rate hikes in 2019, a very different picture from just 6 months ago. Number two, as I mentioned, this takes away expectations that the US economy is heading towards recession anytime soon, and in conjunction with the fact that China's stimulus, fiscal, monetary, and regulatory, is beginning to show up in the data, and people are a little less concerned about China experiencing a hard landing. The combination of all these factors has created a much longer runway for emerging market assets. Now, to be sure, all of this played itself out in other emerging markets a month ago. Argentina, Brazil, South Africa, Turkey, Indonesia got lots of inflows. India had not received those inflows a month ago. So what you're seeing in India is a bit of a catch-up. Also, there are pull factors here, as we were discussing. I think the worst concerns of growth are not playing out. Yes, the high-frequency data is patchy, but there are some bright spots as well. Number two, inflation remains benign, and that allows the central bank to perhaps ease policy a little bit more. So I think it's the combination of all of this. Some positive pull factors for India, an increasingly benign global environment, and it's that combination, I think, that's giving rise to very strong portfolio inflows.
You would reckon that this is not all in part due to one event, which is expectations of continuation of the current political establishment, but a lot more that's happening to EMs, and therefore this could well last irrespective of what the permutations and combinations work out on the political side over the next 1 month.
That's right. I think, remember, we went through a period in 2017 where you had this Goldilocks environment for emerging markets, where central banks were patient, growth was doing very well, and China surprised to the upside. Now, 2019 is not quite like 2017 because growth is much weaker, but the fact is, has a bottom been reached? China's activity recently, last week, surprised to the upside. US data is holding up very well, right? The capex data around the world has just showed some green shoots again after a rough couple of months. So the expectation is, well, global growth may not be as weak as had been expected 6 months ago, number one. And number two, we're seeing central banks will be very, very patient. And the combination of that, as I said, creates a longer runway for risk assets and for emerging markets assets more generally. So yes, I think India will be part of that beneficiary list. Of course, the one idiosyncratic factor to keep in mind when it comes to India's oil prices, we've seen crude inch up towards 67. What we don't want is crude to keep moving up, because that will at some level spoil the party.
Okay. Great. Sajjid, thanks so much for giving us both sets of views. Really appreciate your time this morning. Have a great week ahead.
Sure thing.
All right, that's Sajjid Chinoy of JPMorgan with his thoughts on what's happening to the economy and what's happening to flows and the reasons thereof. Not just India specific, a bit of a catch up to the other EMs.